Coinage and banking systems in economic history. Coinage and banking systems are two pivotal elements in the evolution of economic structures throughout history. The advent of these systems marked significant transitions from barter economies to more sophisticated forms of trade, investment, and wealth management. Their economic impact is profound, influencing both the macroeconomic stability and the growth of individual markets. Understanding the role of coinage and banking requires exploring their historical origins, their functions, and the transformative effects they had on the economy. Origins and development of coinage. Coinage, in its simplest form, is the system of producing metal coins to serve as currency. The earliest evidence of coinage dates back to the 7th century BCE in the ancient kingdom of Lydia, located in present-day Turkey. These coins, made of electrum, a naturally occurring alloy of gold and silver, revolutionized trade by providing a universally accepted medium of exchange, replacing cumbersome barter systems. Coinage provided a standardized unit of value which made transactions simpler and more efficient. The introduction of coinage allowed economies to grow in a way that was not possible with barter alone. It facilitated the expansion of trade both locally and internationally. Coins made it easier for merchants to conduct long-distance trade without the risk and uncertainty involved in carrying goods for barter. As the idea of coinage spread to other ancient civilizations, including Greece, Persia, and Rome, it became central to the functioning of economies, serving as a store of value, a unit of account, and a medium of exchange. The role of coinage in economic growth. Coinage impacted economies in several key ways. By establishing a standardized system of money, it enhanced the efficiency of trade. Coins allowed people to value goods and services in a way that was consistent, unlike barter, where the value of goods could vary dramatically depending on supply and demand. For example, in a barter economy, the value of a cow may differ based on its condition, size, and the area in which it is exchanged. However, a coin with a fixed value provided a more reliable and predictable means of exchange. Moreover, coinage enabled the accumulation of wealth. Unlike goods that could deteriorate over time, metal coins were durable and easily stored. This allowed individuals and businesses to build and store wealth, which could then be used for further investment or trade. In the Roman Empire, for example, coins became symbols of power and prosperity. They were not only used for everyday transactions, but also played a role in showcasing the ruler's authority, as emperors often minted coins with their own images. With the development of banking systems, the economic role of coinage expanded further. Banks, which emerged in various forms in ancient and medieval civilizations, utilized coins and other forms of money to facilitate loans, savings, and the transfer of wealth. The development of these systems allowed for more complex economic activities, such as investments in long-term projects, which were critical for the growth of cities, infrastructure, and trade. The evolution of banking systems. Banking systems have a long history, with their origins traceable to the ancient world. Early forms of banking existed in Mesopotamia, where merchants would store deposits in temples and palaces. These early banks provided a safe place to store wealth, which could then be used for loans. The rise of coinage facilitated the development of more formalized banking systems. In ancient Greece and Rome, for example, moneylenders and bankers began to provide more sophisticated services, including loans, deposit accounts, and currency exchange. One of the most notable early banking systems was that of medieval Italy, particularly in cities like Venice, Florence, and Genoa. These cities were home to powerful merchant families and financial institutions that pioneered banking practices. The Medici family in Florence, for instance, was instrumental in developing the modern concept of double-entry bookkeeping, which allowed banks to more efficiently track transactions and manage large sums of money. The introduction of banking systems had several important economic effects. First, it allowed for the creation of credit. By offering loans to individuals and businesses, banks enabled the expansion of economic activities that would have been impossible without access to capital. This is particularly evident during the Renaissance, when banking systems helped finance major architectural and artistic projects, including the construction of cathedrals and the patronage of artists like Leonardo da Vinci and Michelangelo. The economic role of banking systems and globalization. Second, banking systems facilitated investment. As banks grew in complexity, they began offering a variety of financial products, including bonds and shares. This allowed individuals and institutions to invest in businesses and infrastructure, spurring economic growth. The rise of stock markets in cities like Amsterdam and London in the 17th century allowed for greater pooling of capital, enabling the financing of large-scale projects like colonial expansion and the construction of railroads. Moreover, banking systems also played a crucial role in fostering economic stability. Central banks, which evolved from earlier forms of banking institutions, provided a means of regulating the money supply and stabilizing national economies. By controlling the issuance of currency and managing interest rates, central banks could influence inflation, unemployment, and overall economic growth. The globalization of coinage and banking. With the rise of European colonialism and global trade in the 16th and 17th centuries, the systems of coinage and banking became increasingly interconnected on a global scale. The influx of precious metals, such as gold and silver, from the Americas into Europe had a profound effect on the global economy. European banks began to accumulate vast reserves of these metals, which were used to mint coins and finance international trade. As the global economy became more interconnected, banking systems evolved to facilitate cross-border transactions. The establishment of international banks and the development of a global currency system were essential for financing trade and investment. The introduction of paper money in China during the Tang Dynasty and its spread to Europe during the 17th century marked another important step in the evolution of banking. Paper currency, backed by gold or silver reserves, allowed for the expansion of credit and the growth of economies. In the 19th century, the establishment of the gold standard, where currencies were directly linked to the value of gold, further globalized banking systems. The gold standard provided a stable and predictable system of exchange, which encouraged international trade and investment. However, the gold standard also limited the flexibility of national economies, as governments were constrained in their ability to print money. This system eventually collapsed during the Great Depression of the 1930s, giving rise to more modern forms of central banking. The economic impact of modern banking systems. The modern banking system, which is characterized by a complex network of commercial banks, investment banks, and central banks, has had a profound impact on the global economy. Today, banks provide a wide range of financial services, including savings accounts, loans, mortgages, and credit cards. These services enable individuals and businesses to manage their finances more efficiently, invest in long-term projects, and take on risk to generate higher returns. The growth of electronic banking and digital currencies, such as Bitcoin and other cryptocurrencies, has further transformed the banking landscape. Digital currencies, while still in their infancy, have the potential to revolutionize how people conduct transactions and store wealth. These currencies operate independently of traditional banking systems and offer the promise of lower transaction costs and greater financial inclusion, particularly for people in developing countries who lack access to traditional banking services. Furthermore, modern banking systems play a central role in shaping macroeconomic policy. Central banks, through their control of monetary policy, influence inflation rates, interest rates, and employment levels. The decisions made by central banks have far-reaching effects on economies, affecting everything from the cost of borrowing to the price of goods and services. For example, during the global financial crisis of 2008, central banks around the world slashed interest rates and implemented stimulus packages to stabilize their economies. Conclusion: the economic impact of coinage and banking systems. The economic impact of coinage and banking systems cannot be overstated. From their origins in ancient civilizations to their modern-day applications in global finance, these systems have transformed economies and facilitated the growth of trade, investment, and wealth. Coinage provided a standardized medium of exchange, while banking systems enabled the creation of credit, investment, and economic stability. Together, they laid the foundation for modern financial systems, which continue to play a central role in shaping the global economy today.